This is Philip Chao. I'm the founder and chief investment officer of Experiential Wealth. The Federal Reserve had their meeting, the FOMC meeting, in March and also in May. And in March, it was pretty clear that the Federal Reserve is going to come to an end of its hiking cycle pretty soon. Myself and the market in general have been thinking they have at least one more, probably no more than one more of a rate hike, which they did in May, 25 basis points. That was all within our expectation. So we think that right now it's about the end of the hiking cycle. And it's going to stay at that rate, 5.25, for the foreseeable future. Let's step back for a moment. What is the purpose of the Fed? And Fed does this just about every time when Chair Powell or anybody talks about the Fed, is that they have two mandates or dual mandate. One is price stability, which is basically saying to us, we want to keep inflation in check. In check meaning close to 2%. And number two is to have full employment. Now, full employment is not really well defined. What is full employment? Every single individual in America is employed? Not really. Full employment for the longest time is considered 5%. In other words, if there's 5% of the people unemployed, we think that's close enough to full employment. Perhaps it is not 5 anymore, and for a whole bunch of reasons. Right now it's in the 3.4% range. 3.6% range, not 5. So there is no real number that says for this number to hit this number, then it's full employment. But we are in full employment as far as we can tell. The Fed's interest is to play balance between the two mandates and to reach both of them as often as they can. So right now, and it's been for a long time, or certainly post-COVID has been true, that unemployment has been very low, that the labor market is very tight, and yet inflation is high to very high. So the Fed has been able to say, gosh, at least we got one of the mandate met. Let's go full force in meeting our other mandate, which is price stability. And they also understand that in order to obtain price stability, we have to do one thing, is less demand for goods and services. Inflation is because too many people chasing too few goods and services. We just want to go spend money and buy stuff. That is telling me everybody is working, or just about, and we are spending. So there is what the Fed will call an imbalance between supply and demand of labor. For the longest time, for every unemployed individual, there are 2 openings statistically. Now it's probably 1.5, 1.5, 1.75 job for every worker who's looking for a job. That's pretty rich. Basically saying if all the skills matches up, well, then everybody should have a job. So the Fed is pretty emboldened about this and saying, look, we have plenty of room. Let's just keep raising rates and get this price under control. And chances are we're still at or close to full employment. So that's where we are in terms of how Fed has been thinking, and what they are looking for are data that to tell us affirm or decline our thinking. So labor market continues to be the bright spot in the economy after all this. So in the April Bureau of Labor Statistics, the Employment Situation Report, it stated that the total non-farm, people who are not on the farm, payroll employment increased by almost 250,000, 253,000 in April, as compared to an average of 290,000 over the last 6 months. So 250,000 is a lot of people. The unemployment rate changed very little at 3.4% right now, so it's still very low. And total unemployed individuals remain at 5.7 million. At the same time, the number of persons not in the labor force, meaning that they are not working and want a job, have increased by about 346,000. What does that mean? Meaning there are more people coming back into the labor market looking for jobs because the job market is still pretty darn good. And that's a good sign. We need more people coming in so that wage pressure is going to be lower. So right now, about 5.3 million people not employed. And they were not counted as unemployed, these 346,000 I mentioned that's come back in, because they were not actively looking for a job, and that's what's required over a 4-week prior reporting period. So both the labor force participation rate is at 62.6%, and the employment to population ratio, which is meaning that how many people are employed within the entire population pool, is 60.4. These haven't changed, and they are actually higher than during the pandemic for sure, and we're back to the pre-pandemic level. So as far as we are concerned, or as far as they are concerned, the employment situation is quite good. In fact, very good. Average hourly earnings for all employees on a private, again, non-farm payroll went up by 16 cents or 0.5% to $33.26. And over the past 12 months, the average hourly wage went up by 4.4%. Good. It came down a bit, but it's still going up. So the wage are slowing, but it's still increasing. If you have increasing wages and very tight labor market, it is hard to beat back inflation. So it is not likely that we are going to have a economic contraction or a recession if we continue to have this type of labor market. That may all begin to change for 2-3 reasons. One is that we are seeing a slowdown in hiring, and we are seeing a slowdown in wage gains. Not good for people who are looking for a job or wanting to make more money, but it's good from an inflation standpoint of beating back inflation. Number two, remember, we have 3 bank failures, and these are small to mid-sized banks. They play a very important role in lending to businesses and to providing mortgages and providing commercial mortgages, especially across the United States. With 3 banks' failure, likely that will tighten financial conditions, meaning that they are not going to lend out that easily, and the terms are going to be harsher, there's going to be more regulation, and it's going to constrain the ability for businesses and real estate owners to borrow. And if we cannot borrow, we cannot build, we cannot expand, and things that we need, so that will naturally slow down the economy. Number 3 is what the Fed calls long and variable lag. Historically, it takes 12 to maybe 18 months before the impact of hikes, of interest rate hikes, to be felt by the general economy. Now remember, the first hike went on, the first 25 basis point, 0.25%, was in March last year. So we barely passed the 12-month range. So we think that that impact, plus the bank impact, plus the slowdown, is going to get us to potentially a hard landing or what we call economic contraction or recession towards the end of this year. We hope that doesn't happen, but we don't want to certainly rule it out.